Hey everyone, and welcome! Today we're going to dive into something pretty fascinating. A strange, powerful force that moves markets but has, well, nothing to do with earnings or economic reports. Nope, it's all in our heads. We're going to unlock the market's mind and talk all about psychological levels. So, have you ever seen this? You're watching a stock, it's climbing, you're sure it's about to blast off. And then it hits a nice, clean, round number like, say, $100, and just stops, dead in its tracks. It's like it hit some kind of invisible wall. It's weird, it can be super frustrating, and it happens all the time. Okay, check this out. This is a perfect example. We're looking at the euro versus the US dollar. Now, look at how the price drops down to that 1.00 level. Traders call this parity. It just means the two currencies are equal in value. But see how it bounces? Not just once, but over and over again. It's like there's an invisible floor there holding the price up. Yeah, these are those invisible walls we're talking about. They have no real basis in the economic data or how a company is doing. They are purely a product of psychology. So, what is really going on here? How do these imaginary lines have such a real, powerful impact on the market? All right, let's solve this mystery. It all comes down to a concept called psychological levels. So, the official term is a psychological level, and here's what it is. It's a price point that matters not because of some complex financial formula, but just because it's a round number or a place where the market turned around before. In other words, it's important simply because we, the traders, collectively decide that it is. And these things are absolutely everywhere once you start looking. The most obvious ones are those big round numbers like 100 or 50. They just feel like natural places to pause. Then you've got currency parity levels, like that 1.00 mark we saw with the euro. Even old highs and lows on a chart become these psychological anchors because traders remember them as important battlegrounds. So this is the really critical question, right? If these levels aren't based on hard data, where in the world do they get their power? What makes these invisible walls so strong? Well, the answer isn't in some fancy algorithm or spreadsheet. It's us. It's all of us. It's a classic case of collective belief. See, when enough people believe a certain price level is important, their actions actually make it important. It's the ultimate self-fulfilling prophecy. Just think about how our brains work. We like things to be simple, clean, and easy. We say something costs around the $100, not $97.52. Our brains are just wired for these kinds of shortcuts. And in trading, this little mental quirk leads us to give more weight and importance to these nice, clean, simple numbers. One of our sources put it in a way that I just love. They said that traders become psychos when prices get near these levels. It's a funny way to put it, but it points to a very real truth. These numbers can trigger emotional, almost herd-like behavior that has very little to do with rational thinking. And this just nails it, right? This is what it's all about. It's not one person's decision. It's the combined psychology of the crowd, this massive, swirling force of shared belief that can literally move billions of dollars. And this is that self-fulfilling prophecy in action. I mean, picture it. Thousands, maybe millions of traders are all staring at the same level. They all think, okay, 100 is the ceiling. So what do? They put their sell orders right there. So as the price gets close, it hits this massive wall of selling pressure and boom, it reverses. The belief created the reality. Okay, so this is all fascinating stuff. But the real question is, how can you actually use this knowledge? Well, there's a pretty simple 3-step playbook for trading these psychological levels. First, you've got to become a bit of a market historian. Just go back through the charts and find those key levels where the price has reacted before. Where did it turn around? Mark those big round numbers. Second, you become a detective. As the price starts getting close to one of your levels, you watch it like a hawk. You're looking for clues. Is trading volume picking up? Is the price slowing down, kind of hesitating? That's the market telling you it's paying attention. And finally, you become the strategist. You use all that info to plan your move. That might mean buying after you see the price successfully bounce off a support level, confirming that it's strong. Or maybe it means putting a sell order just below a known resistance level to catch that expected reversal. But, of course, these invisible walls, they aren't indestructible. They can and they do break. So what does it mean when one of these powerful psychological levels finally comes crashing down? When a price doesn't just tap a level, but smashes right through it, that's a huge deal. It's like a dam breaking. It's a really powerful signal that the whole underlying mood of the market has changed in a big way. The old rules are out the window. A breakout like that signals a decisive win for either the buyers or the sellers. That old consensus, that self-fulfilling prophecy that held the line, is now broken. And this often kicks off a huge wave of new orders, which can lead to a really powerful, sustained move. Sometimes, a falling wall is a much stronger signal than a standing one. So let's land on this final thought. If the entire global financial market can be swayed by these invisible lines, these collective beliefs, then what does that say about the invisible lines you're drawing in your own mind? What biases are shaping your own decisions, not just in trading, but, in everything? It's definitely something to think about. Thanks for watching.